Over the past months, something unusual has been happening beneath the surface of global markets. Yields have moved without clear inflation catalysts. Currency relationships have shifted without obvious political triggers. Liquidity has tightened in places where policy has not visibly changed. These are not coincidences, they are signals. They point back to a subtle decision made in Japan, not one that dominated headlines, but one that quietly altered the incentives governing how capital flows across the global financial system. To understand why this matters, it is necessary to step away from daily market narratives and look instead at the underlying mechanics of global liquidity. Markets are not moved primarily by opinions, forecasts, or headlines. They are moved by incentives, constraints, and relative return calculations embedded deep within institutional decision-making frameworks. When those inputs change, behavior changes, often before the narrative catches up. Japan occupies a unique position within this system. It is not simply another developed economy adjusting domestic monetary conditions. Japan is the world's largest net creditor nation. Japanese institutions collectively hold trillions of dollars in foreign assets, spanning sovereign bonds, corporate credit, real estate, infrastructure, and equities across nearly every major market. Over decades, Japan has functioned as one of the primary exporters of capital to the rest of the world. This role did not emerge by accident. It was the result of a prolonged period of ultra-low domestic yields, demographic pressures, and the structure of Japan's financial system. Pension funds, life insurers, and banks in Japan are tasked with meeting long-term liabilities in an environment where domestic returns were insufficient to do so. The rational response was to deploy capital abroad in search of yield, duration, and diversification. Over time, this outward flow of Japanese capital became embedded in the architecture of global markets. Japanese demand helped absorb enormous quantities of foreign government debt. It supported corporate credit markets. It contributed to real estate valuations in major financial centers. It facilitated infrastructure financing in both developed and emerging economies. Entire asset classes came to rely, at the margin, on Japanese participation. The key point is that this was not speculative capital chasing short-term returns. It was structural capital allocated by institutions with multi-decade horizons. When such capital enters a market, it shapes pricing, volatility, and correlations in slow but powerful ways. And when it begins to withdraw or reallocate, the effects can be equally significant. For years, the global system adapted itself around the assumption that Japanese capital would remain outward-oriented. Portfolio construction models, risk frameworks, and asset valuations implicitly incorporated this reality. Japanese institutions were treated as a stable source of demand, not necessarily aggressive, but persistent. The subtle shift occurred when the Bank of Japan adjusted its yield curve control framework. On the surface, the change appeared modest. A technical adjustment to the tolerance band around long-term government bond yields. The language was careful. The signaling was gradual. Many observers interpreted it as routine calibration rather than strategic change. But the significance of the adjustment lay not in its headline description, but in how it altered the incentive structure facing Japan's institutional investors. By allowing domestic yields slightly more flexibility, the Bank of Japan changed the relative attractiveness of domestic versus foreign assets. This did not suddenly make Japanese government bonds compelling in absolute terms. It did, however, change the opportunity cost calculus. For an individual investor, a small change in yield may appear irrelevant. For institutions managing trillions of dollars under strict duration currency and risk constraints, incremental changes can trigger large-scale reoptimization. These institutions do not react emotionally, they respond mathematically. When domestic yields are artificially suppressed, foreign assets dominate allocation models by default. When domestic yields are allowed to move, even modestly, those models begin to generate different outcomes. Capital does not rush home overnight, it begins to shift at the margin. This is how global liquidity is repriced, not through shock, but through accumulation. Japanese pension funds and insurers were not instructed to repatriate capital. There was no mandate, no announcement, no coordinated action. Instead, the policy adjustment altered the inputs into their models. Over time, this allows portfolios to rebalance toward domestic assets in a controlled, phased manner. The importance of marginal flows cannot be overstated. Markets are not priced by the average participant. They are priced by the marginal buyer and seller. When a consistent source of marginal demand slows or reverses, prices adjust even if total holdings remain large. This is why the effects of Japan's adjustment began to surface in markets far removed from Japanese government bonds. Government yields in other developed economies moved higher even without new inflation data. Credit conditions tightened despite stable policy rates elsewhere. Currency relationships shifted as funding dynamics evolved. These movements were often explained in isolation. A bond sell-off attributed to technical positioning. Currency volatility blamed on risk sentiment. Credit spreads widened due to vague concerns about growth. But taken together, they form a coherent pattern when viewed through the lens of changing liquidity incentives. At the same time, the adjustment began to affect one of the most important mechanisms in global finance, the yen's role as a funding currency. For decades, the yen functioned as a cornerstone of global funding strategies. Borrowing in yen at low cost and deploying capital into higher-yielding assets elsewhere became a standard component of institutional portfolios. These strategies were often hedged, structured, and integrated into broader allocation frameworks. They were not reckless, but they were sensitive to changes in funding costs and currency dynamics. As domestic Japanese yields gained flexibility and the yen began to strengthen modestly, the economics of these strategies shifted. Funding costs increased incrementally. Currency volatility rose. The return profile of carry-based positions deteriorated. Carry trades do not unwind explosively under normal conditions. They unwind through reduced reinvestment, partial position reductions, and selective deleveraging. The process is gradual, but the direction matters. When a dominant funding mechanism becomes less attractive, the system adapts. The effects of this adaptation extend far beyond currency markets. Assets purchased with yen-based funding face reduced demand. Volatility increases as positions are adjusted. Correlations rise as diverse assets respond to the same underlying liquidity driver. This dynamic helps explain why markets that appeared fundamentally unrelated began to move together. It was not narrative contagion. It was funding contagion. Beyond market mechanics, Japan's adjustment also reflects a broader shift in how major economies are thinking about financial resilience and sovereignty. For much of the post-crisis era, global financial integration was treated as an unquestioned good. Capital flowed freely across borders, and efficiency gains were prioritized over resilience. That framework is now under reassessment. Geopolitical fragmentation, sanctions, supply chain disruptions, and strategic competition have altered how countries evaluate risk. Dependence on external funding is no longer viewed as purely beneficial. Domestic financial flexibility is increasingly seen as a strategic asset. Japan's move fits within this evolving context. By allowing domestic yields more room to adjust and reducing reliance on perpetual outward capital flows, Japan is strengthening its internal financial architecture. This does not represent isolationism. It represents recalibration. The concept of optionality is critical here. By improving domestic return dynamics, Japan increases the range of choices available to its institutions. They are no longer compelled to deploy capital abroad simply to meet return targets. They can be more selective about where and how they invest. Selectivity changes the global distribution of liquidity. Capital flows become more discriminating. Assets that relied on indiscriminate demand may struggle. Assets that offer durable cash flows, strategic relevance, and resilience may be favored. Other countries are watching closely. Economies with large external asset positions face similar trade-offs. How do you maintain domestic stability while remaining integrated with global markets?